Good evening, everyone, or afternoon, depending on where you're joining us from today. And welcome to the very first Apella Academy webinar of 2026. Very excited to share another incredible year of financial planning and investment education with all of you. You know, all of us here at Apella are truly honored to be able to provide this service to so many people and to have each and every one of you so engaged in the process of lifelong learning. If you happen to miss last month or any of the previous months, please, as a reminder, go to apellawealth.com, head over to our events page. There you're going to find all of our most recent sessions, including we just did something last month on the complexities and challenges around generational wealth transfer, which was very well received. I'd encourage you all to go watch that if you happen to miss it. But all of the 12 or so sessions that we did last year are all recorded up there and available for review. So today we take a look back at 2025 and what a year it was. So there's a lot to cover, but as always, just a few housekeeping items. We are recording today's session, and as always, my ask is that please share this with friends, family, really anybody who has an interest in being informed and up to date about what happened in the market last year and some ideas about how to be and stay invested throughout 2026. As we proceed through today's session, please use the Q&A function you'll see probably at the bottom of your screen to ask any questions. We don't want you to be shy, so please load up that Q&A box. We will try to get to as many of them as possible. And with all that said, it's time to welcome back our favorite guest, who is kind enough to join us twice a year, sometimes three times if we beg and ask nicely. But Apollo Lupescu is joining us. He's, as you all know, Vice President at Dimensional Fund Advisors, one of the world's premier investment managers. If you haven't seen him speak, you're in for a real treat. Apollo has an incredible knack for breaking down some of the most complicated investment topics and making them enjoyable, right? He makes them so just about anybody can understand them. He weaves in stories and humor, which really, I think, Apollo, you'd probably agree. Investing is a really difficult, challenging,
Right.
somewhat frustrating, and complicated universe. And we certainly appreciate your ability to make it digestible for so many of the folks that we work with. So thank you so much for coming back again and welcome.
Well, hi, Jason. Thank you. Great to see you. Happy New Year. And, again, thank you for the invitation to be part of this. And that is actually one of my main goals is not to confuse people, but bring some clarity onto something that otherwise seemingly seems so complicated.
Well, with that being said, we're going to dive right in. And while 2025 was a very good year in the market, it was somewhat of a confusing year if you kind of watched the ebbs and flows. So why don't we just dive right into the equity markets? Maybe we'll kind of go across geographies and start with what happened in the United States last year in the stock market.
Yeah, and that's a great place to start. And one quick note, you mentioned the planning that you do for folks, and
Yeah.
I think that's hugely important because when you build a financial plan like Capella does, you look at somebody's circumstances, their needs, their risk capacity, and some of you are likely to have some money invested in stocks. It's also possible that some of you might have some money invested in bonds, which is a different form of investment that has to do more with lending rather than an ownership in companies. And the two of them have very distinct characteristics. So when you look at your own statement, it's likely going to be a little different than what you see on the news, just because it has this balance of stocks and bonds. But starting with stocks, to Jason's point, how is the stock market done? And in that context of the plan and the way that Appella builds portfolios, what's really interesting is that there's not one single component to the stocks portion of the portfolio. If you look at 2025 and you look at stocks comprehensively around the way you are invested, I'm familiar, I've worked enough with Jason to kind of have a sense of the investment approach. And you look at stocks, what's interesting is that the biggest part of somebody's portfolio is likely to be invested in the US market. So when you look at the US market comprehensively, there are about 3,000 different companies to which you likely have some level of exposure. And that comprehensive market measure in the US roughly is went up by about 17%, which is really great news because what it means is that if you started the year with $100, by the end you would have $117, which is above the long-term average of 10% growth. So really nice growth in the growth in the U.S. market. Now, what's also interesting is that over the past few decades, investors have realized that the U.S. is an important component, but not the only opportunity set in the world. And if you look at a second leg of the stool, which is international developed markets, and those are markets that have good legal system, good contract enforcement, and so forth. That set of countries also went up in value. But what's fascinating, Jason, it was significantly more. It was 32%, almost twice as much as the US. So significant growth in international markets. And then the third leg of the stool is what we call emerging markets. And these are countries that don't have as robust of a legal system, and they're still great functioning. It's just not as robust as the other ones. And the set of emerging markets also went up by about the same 33%. So great news to report. Whether you look at US, international, emerging, we did see very good results. But to kind of bring a little more clarity to international developed and emerging, the international developed combines a set of individual stock markets. And not all of them certainly went up by 32%. In fact, Jason, what's interesting is that the best performing stock market in international developed last year happened to be Spain. As I said, international as a whole, international developed went up by 32%, US 17. What's remarkable was that Spain went up by 80%, 80% growth in the Spanish stock market, and right behind it was Austria, and Austria was up roughly about 78%. And there were some countries there in the middle, and the lowest two performers in international development. And I think this is fascinating. The second worst performer happened to be Australia. But don't feel bad about Australia because even being the second worst, it still outperformed the US. Australia was up about 18%. And there was one country that did have a negative outcome, negative 8%, and that was Denmark. And for the folks who are not familiar, their big company there is called Novo Nordisk, and that's the company making Wegovy and all the diabetes treatments. So they shed not only some weight, but they shed some points as well. Didn't go up for the year. Now, in emerging markets, technically the best performer was Colombia, but really the one that stood out to me was South Korea because it's a more significant part of the emerging markets universe. And South Korea was up a whopping 97%. 97%, phenomenal performance for the South Korean market. And another performer that was close to top was South Africa. And the reason I brought in South Africa, not just because it's another South, but it's because South Africa is dominated by gold mining stocks, and gold did really well, and so did the market there. So even though you might not have owned gold directly, the exposure to South Africa led to that really nice return of 70% growth. And on the bottom, we saw Philippines, negative 1%, and then the worst performer in emerging markets was Turkey at about 3% negative. So I think the really good news to report, Jason, is that we did see a solid performance across the board, not just in the US, but in other markets. And maybe there's one other quick element to touch before we kind of dig deeper in the US, still looking at international. One of the biggest news last year was around tariffs. And we have a new government in DC, and it was a big push to impose tariffs. And that was supposed to help the US and perhaps not help other countries. So if you look at the US stock market, as I mentioned, it was up about 17%. But we were the ones imposing the tariffs. And other countries were supposed to be impacted and negatively because they were selling so much to the US and now they can't. And the one that really was reserved for the greatest tariffs, as far as I know, 145% at one point in time was China. So the question is, how did the Chinese stock market perform in a year when it was confronted with these horrible tariffs for them? And the answer is, well, if the US went up by 16.8, 17% or so, they did not go up by 17%. They went up by 31.5%. They, significantly outperformed the U.S. market despite the tariffs. And then we also had a little trade spat with our friends to the north, with the Canadians, and they're supposedly selling a lot to the U.S. So, we didn't know how the market's going to perform. But what's remarkable is that the Canadian stock market delivered twice the returns of the U.S., 38.7%, significant growth despite the tariffs. And certainly they have their gold mine and their gold stocks and silver and so forth. And there was one other reason. But you look at Bombardier, which is the company making airplanes, it was up over 100%. Toronto Dominion, TD Bank, it was up over 50%. So was Shopify and Dollarama, which is their version of dollar stores. So it was across the board that the Canadian stocks did pretty well. And even our friends to the south, you have the Mexican economy supposedly so exposed to U.S. Tariffs, and what you saw is that the Mexican stock market went up by 54%. So the point that I want to make here is an interesting one, because I'm not going to suggest that tariffs don't matter. Of course they matter. They will impact the economy and businesses and so forth. I just caution people from drawing direct conclusions. Oh, tariffs are coming in. This is going to happen. I know exactly how the market's going to perform. There are a lot of factors, a lot of variables that drive the market. Tariffs could be one of them, but it doesn't appear they're the primary factors, neither for the U.S. nor for other markets. So it is quite interesting, and kind of going back to tariffs. What's also very interesting to me is kind of the way that we started last year with the tariffs, and it was such a big story, and then we had a negative quarter when U.S. investors lost about 4%. And what we always kind of coach people is that, listen, the market has reacted to that already. We don't know what's going to come next. What you want to avoid is getting caught up in the emotions and the anxiety of the moment. And folks who actually stayed diversified and disciplined, what they saw is that the second quarter in the U.S. stock market, in the S&P 500, was quite significantly positive, to the point where for the first half, you're actually ahead of the game. The market was positive through July, and then it continued. Q3, another solid quarter, and then Q4, another positive one. So investors who did not get really caught up and succumb to the emotions of the first quarter, when it really felt different and weird and unprecedented, they really they got rewarded, because ultimately for the entire year, the S&P 500 was up roughly about 17.9%, almost 18%. So once again, great news to report. The S&P being the largest 500 companies. And Jason, I always want to dig a little deeper, because when you look at this number, 17.9, it doesn't mean that every company went up in value. In fact, if you were to pay a little closer attention to the positive negative, what's fascinating to see is that last year, about 64%, about two-thirds of the companies in the U.S. stock market made you money. They had positive returns. Their value was greater at the end of the year than it was at the beginning. But it also means that about a third of them went down in value. In other words, you lost money on them. And for a lot of investors, the obvious question is, can I avoid the negative ones and just put all the money in the positive ones? I wish there was something that anybody can tell you without selling you fantasy. And I'll give you some examples just to see that it's not as clean as one might say, that a sector is going to do well. It's quite random. If I gave you two retail giants, Costco and Walmart, at the beginning of last year, and asked you, well, which one of these is going to be in the positive and which one in the negative? I'm not sure that anybody could have predicted that, but it turns out that by the end of the year, both retail stores, Costco was in the red and Walmart was in the positive category. Again, can anybody predict that? Secondly, you have Verizon and T-Mobile. I mean, they're substitutes for cell service. It turns out that Verizon went up in value, was in the plus category. T-Mobile was in the negative, even though they pretty much sell the same thing. And then probably the best example, the one that always seems to be, like, to me at least, the cleanest, is Coke versus Pepsi. And it turns out that Coke was in the positive category, Pepsi was in the negative. So this idea of somehow being able to tell which companies are going to go up and down, it's futile. It's not worth it. It's just so too imprecise. And this is just looking at positive negatives. You can go a step deeper and say, well, by how much? And that's even more interesting because if you explore by how much did these companies go up or down, what you see that is in the S&P 500, there were six stocks, six of them then lost more than 40% in value. And that's unpleasant as an investor. These six stocks lost more than 40% of your money. And which companies are those? Well, the bottom three were Lululemon, lost 45%. Decker Outdoor, which is the maker of Hoka shoes, about half its value. And the worst performer is a financial company called Fiserv. But it also is interesting that as we see with data in the market, the more you move towards the middle, in other words, the returns that are kind of in the middle. And in this case, if you look at stocks that had growth between 0 and 10%, well, there are 85 companies in the S&P that had that result. There are another 89 companies that had 10 to 20%. So the more you move to the center, the more of these companies would fit into that category. Now, if you go to the other extreme, on the positive side, what's remarkable about last year is that we did not expect statistically to have as many high flyers as we had. If you look at these companies, there are 66 stocks. They went up more than 40% in value. That's a lot. That's a lot of companies that had outstanding results. And if you look at some of those, towards the top, you find something like Warner Brothers. Warner Brothers, the movie studio. Who knew that you make money in movies? It was up 173%. Forgot about Nvidia and Google and all these other companies. 173% in Warner Brothers. Newmont Mining, which is a gold stock, has exposure to gold. And then the best performer in the S&P last year was Western Digital, the company making hard drives. You remember the days when you had to back up your computers on hard drives? Western Digital made some of those. They were the best performer, and it was over 280% return. So fantastic results. And just as a side note, outside of the S&P, there are about 2,000 other smaller stocks called the small caps or the Russell 2000. And within those, what was amazing is that there are over 100 companies that had returns over 100%. And some of the best performers were, I think there was a Solidity, which is a biotech that was up over 600%. You had companies like EchoStar, which owns Boost Mobile, and also some satellites that was up over 300%. And my favorite, I keep seeing boxes at home from ThreadUp. I think my wife or my daughter buy from that vintage store, and that stock was up 350%. So again, forget about AI. ThreadUp was the game in town. But ultimately, for the S&P 500, what we're doing as investors, we're measuring the combined performance of these 500 stocks, and that was roughly about 17.9. And to get to the number, we don't just simply average those because some companies are more significant in the market than others. And what the S&P does and what investors do is actually place a greater emphasis on the performance of the largest stocks. And larger, it means what is their overall value of ownership? What's the value of that company? And the larger the company, the greater the emphasis on its performance. And that's why when you hear Magnificent Seven, that's relevant to you not only because they're large, well-established, mature companies that we use all the time, but also because they're some of the largest in the market. And they do have a pretty important, significant impact on the performance of the S&P. If you take these seven stocks aside and you look at their performance, when the market was up less than 18%, these stocks were up by 22.7. It was almost 5% more on average for these Magnificent Seven, and they left a hole in the S&P. So if you look at the S&P 500 minus 7, the S&P 493, it also went up, but a more modest 15.3. And the reason I think it's important is that you can somehow bump up performance from 15.3 to almost 18, so 2.5% only by exposure to seven stocks. And the reason for that is because these seven stocks combined together amount to roughly about 35% of the value of the entire S&P. So about a third of the performance of the S&P is driven by these seven stocks. And what's also interesting is that the same Magnificent Seven are also part of a different market metric called NASDAQ. The difference is that instead of 35%, they are at 54%, which is nuts. More than half of the value of NASDAQ and more than half of the performance of NASDAQ is driven by seven stocks. And that's really concentrated, if you ask me. And if you were to invest in the way that we just talked about, the way that Appella looks at it is a global opportunity set, there are about 12, 13,000 different companies. You would certainly have exposure to these Max 7, but instead of 35 or 54, it would be a lower percentage at about 19, say, in that neighborhood. So you have exposure, you're not as concentrated, and it has two major implications here. One implication is that your performance was not designed to match NASDAQ. Meaning, like if you look at the results of NASDAQ and you look at your own portfolio and it doesn't match, that's by design. Because if they wanted to match NASDAQ, they would put more than half your money in seven stocks, which I don't think is that prudent. But secondly, at times when the Mag 7 are doing fantastically well, it's possible that NASDAQ might look better than the other metrics. And that's exactly what happened. NASDAQ went up instead of 17 by over 20% last year as a reflection of the higher concentration in these seven stocks. The opposite could also be true, or it could be true that international does better and the world stocks still outperform. But I think that Mag 7 are a big story, and it's not, Jason, I'm going to wrap it up because it's not just last year or the year before. It's been a while now since the market has been kind of seeing the impact of these Mag 7. If you look over the past decade, you take an entire decade and you look at the stock market in the US, all the Starbucks, the McDonald's, all the companies that we love in the S&P without the Magnificent Seven. So without them, over the past decade, it went up by about 202%. So it's a big growth that we saw in the market without these Magnificent Seven over the past decade. Now, what about the Max 7? How do they do relative to this sort of like the remaining stocks in the S&P? And when you look at the data, it's quite shocking. The same period, the Max 7 didn't go up by 202, but rather a whopping 999%. If they had tried just a bit harder to get to 1,000. But the reality is they did significantly better than the market. So the U.S. market, when you talk about the U.S. market, you have to take a step back and say, to a certain degree, the great performance that we've seen over the past decade, particularly relative to international, is really been on the base of a handful of stocks that have just been flying so high. So it is important to acknowledge the Max 7. You did not miss out on them. And if you don't match their performance, it's by design because you want to protect yourself just in case these Max 7 won't fly high for forever and ever and ever.
Before we pivot to what comprises a large portion of many of our investors' portfolios, bonds, I wanted to keep down the path of equities and really
Yep.
kind of highlight AI stocks and get your opinion. The valuations on these stocks has been off the charts. We saw some volatility, maybe some shakiness towards the end of 2025. Um, what's your thought on the kind of the nature of those stocks in a person's portfolio, representative of the market? Like, what's your view on AI
Yeah.
stocks valuations and the risk in such concentrated positions?
Yeah, that's a great question, and to begin, I'll take a step back because I want to make sure that everybody has an intuitive idea of what is valuation. Because I feel that a lot of times we speak this foreign language of investing, and to us it seems so second nature. But I was talking to just some friends the other day, and one of them actually raised their hand. It's like, listen, you keep talking about valuation. I ask you about valuation, but I'm actually not sure exactly what is valuation. Can you explain it to me? So it got me thinking, and so how would I explain valuation in the context of stocks? And it kind of starts with what exactly is a stock, and a stock is really a piece of ownership into a company. If you own a restaurant and you have 100% of the restaurant, well, 100% of the profits go to you because you're the owner. In the case of the stock market, you are allowed to buy ownership into companies and you are entitled to those profits pretty much like everybody else. If you buy a share of Tesla, you are entitled to part of the earnings pretty much like Elon Musk is, not as much as him, but conceptually have the same claim to those earnings. So valuation really reflects of how much are you paying to get something from that company. And let's just make it real. Let's look at Tesla. We mentioned Tesla. If you look at Tesla at the end of last year, January 1st this year, and you look at the price per share, that was $450. And if you had $450 in your pocket, you can go get yourself a nice jacket, you can go take your spouse to dinner, or you can buy a share of Tesla. What do you get for that share? You don't get the hope it's going to go up. That's not. You get something much more tangible. You get to partake in the earnings of this company. And because you're part owner, you get a cut of those earnings. So what were the earnings in 2025 associated with that one share of ownership in Tesla? Well, if you go out there in the financial media, everybody, you can see it that the earnings per share associated with that one share of ownership were roughly about a buck 50. So what does it mean? What it means is that you paid $450 and at the current rate of earnings, Tesla theoretically comes and puts a buck 50 into your piggy bank. So the simplest way to think about valuation is this. If you spend 450 bucks and you're going to get back 1 buck and 50 cents per year, how many years would it take for you to make that initial investment back? You spend 450, you get a buck 50 per year. That's not that complicated. It takes about 300 years. 300 years to make your initial investment back. That's what valuation means. How expensive is this stock for, in this case, the earnings associated with that one share of ownership? That's what typically is known as price earnings ratio or the P ratio. It's just I'm reframing it as a payback period, which is just the more intuitive way to think about it, in my opinion. Now, instead of Tesla, we talked about the global opportunity set. There's no AI glamour around Toyota. They still make hybrids and regular gasoline engines. But at the same time, when Tesla was trading at $450 a share, you could have bought a share of Toyota at $215. And what's interesting is that the earnings associated with that one share of ownership for Toyota were not a buck 50, but rather about $20, which meant that it would be roughly about 10 years before you get your money back and you are ahead of the game. That's what valuation basically means. Is how much are you paying to own something? And right now it is absolutely true that if you look at some of these Magnificent Seven, their valuations, their price to earnings are quite high. Tesla really stands out. It's over 300. It's a very big number out there for Tesla, which means that not that it's irrational. It's just saying that investors believe that somehow down the road Tesla is going to take over and make their robocars and robotaxis and maybe robocops, whatever. But they're going to make enough things to make money to compensate for this high price. That's what this P reflects, the expectation of great profits down the road. But if you look at the stock market as a whole, the S&P 500, the long-term average in the S&P 500 has been about 2022. And there's only one Mag 7 Meta, which is the same as Facebook. It's the parent company of Facebook. And by the way, Alphabet is the parent company of Google. And there is only one company, Facebook, that is somehow in the neighborhood of the long-term average. Everything else has great baked-in expectations. And that's what the 999% growth shows, that the price kept going up and up and up, but the earnings haven't kept up. It's just the expectation that at some point you'll make it up. And among these seven stocks, the combined sort of price earnings ratio, it's about 68, which is more than 3 times the long-term average in the market. Now, Jason, what about the rest of the stocks, the S&P 493? What's remarkable about it is that the average for those, the price earnings for the rest of the stocks, is not crazy high. It's higher than the long-term average, but not absurdly high. And we talked about small companies in the U.S., the small caps, and their price earnings ratio is lower than the long-term average of the S&P. And within small, there's another category that is really emphasizing more the lower price stocks called small value. And their valuation is even more reasonable. So the story here is that when you look at the valuation in the market, and you hear this a lot, it's a range. I mean, you can go in the market and find a group of stocks with a price earnings of about half of the long-term average, and that's small value. You can go and find the Mag 7. They're 3 times as much. So it's a blend. And I think, if anything, investors at this moment in time, you want to make sure that you are rebalanced, particularly towards small and value, because these are asset classes that have not increased in price. And it's possible that growth might continue, like these companies companies that have this expectation of growth down the road, they might continue to run and run and run and run. You just have to be careful not to overdo it. And if anything, just to make sure that you have exposure to these more fairly priced stocks. And on the idea of AI and the bubble and the correction, that's an interesting one because Jason, have you been playing at all with AI?
I do dabble in it occasionally. Yeah,
Same.
it's a lot of fun.
It's a lot of fun, and I have to say, it's a magical technology. To me, it just feels like personally that it's almost as, oh, it's actually probably like as revolutionary as the internet was. When I can just go and search for something. I don't have to go to the library and pick up 100 books. I can just get it right there. I think a lot of people are saying that this will change the world, the economy, jobs, social fabric. A lot of things are going to be changed. What I want to kind of come back to is how do you think about AI as an investor? And I think AI as an investor is quite interesting because what we've seen with other transformational technologies is that the biggest beneficiaries might not be the creators of the technology, but rather the users. If you think of the scanner in the supermarket, well, who benefits more from that technology? The company making the scanner or the supermarket itself, the user? And I think if you look at it now, there are a lot of creators of this technology. They're kind of competing with each other. You have OpenAI with ChatGPT, you have Google with Gemini, you have Claude, Anthropic, you have Facebook, you have all these Amazon, all of them creating their AI, and they're all going to compete with each other. And the ultimate beneficiary might be non-AI firms, might be the Walmarts, the Costco's, the T-Mobiles, and so forth. All the companies that we talked about, Pepsi and Coke, because they can use AI to improve their productivity and ultimately improve profits. I would not hyper focus on AI because they might not be the biggest winners. You also had the picks and shovels that the biggest beneficiaries were, some company like Western Digital hard drives, or you have energy companies. There are other companies who are feeding the AI frenzy. They might make as much money. So I wouldn't hyper focus on this. Continue to stay diversified is probably a smartest strategy. But the other thing that I do want to come back to for a second is the internet, then the comparison of the bubble in the dot-com era with what we're seeing right now. And I thought about this quite a bit. Is there something about the bubble and the way you think about the internet today versus back then? And one thing that I find it's interesting is as a parallel is that back then when you said I want to invest in the internet. There is no entity called the internet. There is not a monolithic investment called the internet, but rather you have all these horses in a race. They're all racing. And when you're in that race, it's not obvious who the winners will be because you cannot invest in the internet as an entity, rather individual companies. And if you go back to the mid 90s, and I gave you not what you know today, but what you knew back in the 90s, I told you, like, listen, there are three websites. One website that sells toys, one that sells books, and one that sells pet supplies. And I ask you, well, one of these is going to be the future of internet retail. Which one is it? It wasn't obvious at all that it's a book seller, and that's I think that the big thing is that right now, the same as with the internet days, it's not obvious at all who the winners will be. It's just not at all the same way that it wasn't back then. And as an investor, you have to accept that in order for you to get Amazon, you also need to hold eToysandPets.com. And if you're hyper focused on, oh, they went away and they disappeared and I lost money on them, you're missing the point that in order for you to have Amazon, you absolutely need to have those because you don't know which one's going to be the one flying high. But the second big point is that the companies that survive will certainly make up for all the ones who don't, because the internet generated the Amazon, internet generated Google. You have Netflix changed entertainment. You have eBay. You have Facebook. You have all these internet companies that are successful beyond the expectations. And if you just simply focus, oh, but pets.com went down. You're missing the fact that for pets.com, there was an Amazon, and a lot of these companies did not necessarily start that way. My first search engine, Jason, wasn't Google. It was Alta Vista, and then it was Yahoo. Google didn't come till later. My first social media was MySpace, and that went away, and Facebook came along. So it's not obvious. And I think we're in that moment right now where People are looking at AI, investing in AI. Well, you're not investing in AI. You cannot do that. You have to pick horses, and you have to accept. And that's just it's just a feature. It's not a bug that some of these companies are going to blow through billions of dollars, create nothing, and disappear. The same with the internet. And that's you have to do that because at the moment it's not known which ones will survive. And I live I mean, in Los Angeles, and I have a lot of friends who are in Palo Alto, that area, and in Silicon Valley. My brother's in that area, and a lot of these venture funds, a lot of these, historic and well-renowned funds, they know. They know and they will tell you, we're going to invest in 10 companies and we know that six of them are going to disappear. We absolutely know. We're going to put money into them, knowing that they're going to blow through the money and then create nothing. We know that one or two are going to just be okay, maybe chug along, get acquired. But we know that one or two, if we do it right, are going to be moonshots. They're going to deliver the results to cover everything else. And what I found interesting is that that is not just the private equity permeating into public markets today. I actually think it's exactly what we see in the stock market in the US over the long run as well. Because if you look at a group of stocks, let's say 3,000 at the beginning of each period, that's the entire number of stocks in the US market. And he asked the question, well, if you look at a cycle of about 20 years, what percentage of these companies disappear? The answer is shocking. 60% roughly of the companies don't make it. 60% just disappear. They don't survive. They get acquired, they get out of business, 60%. And out of the ones that survive, only about 18% of them actually outperform. So it's kind of very similar to that power law distribution where you have, six or so kind of going away. You got one or two chugging along, and one or two high flyers who actually deliver the results that are so familiar with us. So because of that, again, I think that if you consider a bubble the fact that some companies will blow through money, create nothing, and disappear, yes, I mean that's going to happen. Is that a bubble? No, I think it's very rational because at this moment we don't know which ones will be the next Amazon, the next Google, and you kind of need to own them all.
It's interesting. And I love the history charts. They tell such an incredible picture. And I think it's important to note, like you just said, going back to 1927, obviously a lot of those companies have gone out of business, but it happens every year, right?
Yeah,
I don't know what percentage of companies go out of business every year, but it's not zero.
it's
So it's a trend that continues. A lot of good questions in the chat, so I want to make sure that we get to a few
yep.
few of these. Um, One question about, as an investor, maybe with cash to invest or thinking about putting capital to work, just seems like every day markets are at new highs,
Yeah.
right? And thinking about that, how should an investor approach seemingly day after day after day of the market exceeding the previous day's new highs, setting a new record, and when's the correct entry point for an investor today?
Yeah, so that's a really important question, and because we are seeing it, even despite all the nuttiness in the world, we see all-time highs. And to begin with, the two words that absolutely stick to mind is it depends. It depends. I would not be able to tell anybody when to get in and then when to get out of the market because to begin with, they need to have a plan. And it's quite possible that depending on your circumstances, if you're a business owner where the majority of your wealth is already in your business, well, perhaps a lot of the money should go into bonds and not necessarily the stock market. So it's just so dependent on your own circumstances and that split between stocks and bonds that is not a cookie cutter answer. But if you do need to put money in the stock market, let's say for that portion that you might need to put in the market, is it a good time to put it now or how should you do it? Well, there are two different strategies. One is what's called a dollar cost averaging. And what it means is that instead of putting the money every, all at once, you kind of dribble it over a number of months, whatever period you decide, until it's fully invested. And what that does is psychologically protects you from the regret of what if the market went down tomorrow.
Yeah.
And for some people, it is something that it helps them get in the market and get past that anxiety, the what if the market drops. But is there evidence that once we see all-time highs, that means there's something ominous, and perhaps you should hold back and even like kind of hang on for a minute and not invest? And we looked exactly at that question: is how does the market behave once we reach an all-time high? And we have data in the stock market, and I rather look at data rather than my opinion. And when we looked at this, the question was, okay, so let's look at the market. It's hitting an all-time high, and then you're going to look 1 year ahead. So exactly 12 months after it hit that all-time high, and you want to know, is the market higher or lower 1 year later? And what's so interesting is that if you look at the data, you see that on average, the market is up by quite a nice 13.7%. So 1 year after hitting an all-time high, the market doesn't tank. It continues to rally by 13.7%, which is quite nice. But the question is, well, what if I invest at any other month? Could that afford me an advantage and maybe the market does better? So if you invest after any previous month, what's remarkable is that the market's still up, but by not as much,
Hmm.
which the data seems to suggest that you are better off as an investor investing at an all-time high, because statistically you are likely to make a higher growth on your money than if you invest any other month. Now, this is an average over a long period, but how often do we see this? Do we see this every single period that the market hits an all-time high? No, it's roughly about 80% of the time that after an all-time high, the market will be higher, and the average is by 13.7. But it's also interesting that when you look at any other month, that it doesn't happen as often. So you tend to see the market being higher and by more after an all-time high, which is a little bit contrary to what most people want to believe. Now, by the time you extend this to 3 years, which is a more reasonable time frame for investors, what you see is that it's pretty much a wash. It's pretty much a wash. There's no difference whatsoever whether you invest at an all-time high or any other month. So I think that the answer to the question is that if you have money to invest, I think statistically you are better off putting it to work all at once based on that financial plan. And being an all-time high is not a signal that you should wait. In fact, it's almost like the opposite. The market continues that momentum apparently over the next year. But if you feel uncomfortable and you feel like, boy, there's going to be so much regret if something happens, I can't tell you it's the end of the world if you parse it out over the next 2 or 3 months. And, 20 years down the road, when you look at that money, I don't think it's going to make much of a difference. But if it helps you behaviorally, who am I to tell you that? Because human emotions are real.
Yeah. Yeah, I think when I looked at the statistics last year, it was almost 40 new highs, and then the year before that, it was almost 60. It's so you could wait forever, really.
Absolutely.
So,
Yep.
on the other side of that, we have quite a few investors navigating the early to mid to late stages of retirement. And, when they look at markets like this, they're very excited, right? Obviously, it allows them to do more, to take more, to give more, et cetera. But they're always worried about that kind of impending volatility and, how long can this last? So,
Right.
as retirees or people more reliant upon their portfolio think about that, how should they prepare for kind of that inevitable downturn in the stock market?
Yeah, and that's critical because you used the right word, inevitable. I live in Los Angeles. I'm under no illusion that I'm not going to experience an earthquake. I know it's coming at some point. I just don't know when. It's inevitable. And I think in a way you can look at the market as a whole the same way, that it's inevitable that at some point the market will have a drop, and you have to be ready for that. And the question is, what do you do about it? And particularly as you said, as you get closer to retirement. So the first thing that you ought to do is just 100% make sure that you sit down with an advisor at Apella and you build a plan. Because when you build this plan, the plan is really built to withstand different periods. So the plan might account for you to, hey, what if we don't want to touch the money for X amount of the portfolio for X amount of years, and we just want to have a different reserve. There are all these strategies that you could do to sort of like strengthen the portfolio in times when the markets go down. So the first thing you can do, make sure that you have a plan. And the plan, typically what it does, it tends to look at these two major components of a portfolio. One is the ownership in companies, which is the stocks, and the other one is lending money to corporations and governments at a fixed rate. So you're lending your money, there's a contract with an interest rate, and that is called a bond. And historically, the bonds have given investors more stability. So as you are close to the retirement, what an advisor might do is just say, listen, for your circumstances, if you don't have a pension, you don't have other assets coming in, maybe we do need to shift your portfolio in expectation of that retirement, and make it a little bit more conservative. So the first thing is all about the planning and so forth. But the second big one is to really, in a way, manage the expectations and be able to navigate those choppy markets at a time when it's really hard not to be emotional. And I've seen this over and over how hard it is when the markets drop not to just be fearful and just maybe react based on emotion. And this idea of market downturns, as I thought about it, it's not as clean as one might think, because what is a market downturn to begin with? And I thought about it, and you hear so much about the correction. There's a correction in the market. Well, what exactly is a correction? Well, in my lifetime, I'm born in 1969, we have had about 28 of these corrections, which it's a baby bear. It's a bear cub. It basically the market drops by about 10%. So every other year we do experience these small quakes. So they happen quite frequently, and it doesn't seem to be as big of a deal for most investors just because the recovery is quite quick. It's a 10% drop. It happens quite often. We're kind of desensitized a bit to these corrections, even as we see it sometimes. But we do see, on the other hand, the real bear. The bear shows up, and in my lifetime, there have been about 8 different bear markets. So on average, every 7 years, we see the market dropping by about 20% or so. And that is a pretty significant market drop, and it doesn't happen as often. So you kind of tend to lose sight a little bit about that particular bear market when it's been like 5, 7 years. Well, things just jog along, isn't that the case? But they do happen. So I do want to caution that these bear markets happen. But I also felt that in my lifetime, there are certain markets that are even worse than the bear market. They're really big drops, and I thought, well, what's bigger than a bear? Well, it's a grizzly bear. So I do think that in my lifetime there have been three, something that I call the grizzly bear market, where we had more than a 30% drop and a prolonged recovery. And that doesn't happen that often, but it has happened 3 times. So on average, every 18 years. And I'm not a superstitious guy, and I don't imagine that averages work precisely. And I'm not predicting in any way there's something coming. You just have to be aware that every 18 years or so, on average, you do see some of these grizzly bear markets, and they don't, doesn't mean that much. It means that you have to have that plan. So what can you do if a grizzly bear market comes? Well, the first thing is control the emotions. Acknowledge that these things happen. They absolutely happen. It's not unprecedented, not unusual, even as the media might scream so. But the second thing that he can do is know, well, how long can these last if I watch the media? Because the media is dominating a lot of this. And what's fascinating is that if you look at 73, 74, which is the first grizzly bear market of my lifetime, we had so much going on. We had the U.S. getting off the gold standard. We had the oil crisis. We had Nixon resigning. It was just a stagflation, a lot of negatives. And what's incredible is that the S&P 500, if you had invested on December 31st, 1972, and I'm kind of asking you to put in your own minds, like how long, how many months before it recovered to get back to the same level as you are on December 31st of 72? And the answer is a remarkable 91 months. That's 7.5 years, 7.5 years when you are on the water. And that's what people are afraid of. It's a long time to be on the water. So what can you do about it? Well, the first thing to note is that what you see in the media, the performance of the S&P, is something that is called price only, which means that the S&P does not consider any dividends that the companies are paying. It just says, "Oh, you took the money and you ran with that." They just like don't exist. But what if you take those dividends, which are part of the profits that the company makes, or that are passed to shareholders? What if you take that and, as most people do, reinvest them? You put them back and you buy more. So when the market is down, you keep buying more simply by using the dividends that the companies pay. You just reinvest those. What's amazing is that instead of 91 months, simply reinvesting the dividends would cut that in half. Would cut that in half. 42 months before you actually get back to being even. So the first thing that you can do is, to me, in my opinion, clearly make sure that you continue to invest, if you can, these dividends. And beyond that, we talked about the S&P being the large company stocks, but also having these smaller companies in the U.S., having international stocks, and not limiting yourself only to the S&P and the U.S., and also balancing that with bonds. And this 60/40 portfolio is just generic enough just to kind of give you a sense that it's a blend. But the question is, with just generic blend, how would you have fared during these grizzly bear markets? So in 73, 74, when it took 91 months for the S&P to recover, what you would have seen is that the maximum drawdown was 46%. There was a moment in time when you have seen probably half your portfolio, close to half the portfolio evaporate. That's a big loss. So 91 months and a 46% maximum drawdown, that's a pretty grisly bear market. Now, if you had this portfolio instead, what's remarkable, instead of 91 months, it would have taken you just about 3 years, and then you're back in black. And then instead of 46% maximum drawdown, the worst loss you'd have seen is about a quarter of your portfolio. So very different. So there is something that you can do about it. And you can examine the other grizzly bear markets. The next one was in the dot-com bust. We talked about the internet bust, and if you look at that one, it lasted 81 months before you recovered your losses, and the maximum drawdown was very similar, about 46%. But if you were in this balanced portfolio that we talked about, and this is something that advisors offer, what you see is that instead of 81, it would have been half of that. In about less than 3.5 years, you're back in black. And the maximum drawdown was more like 20%. So it doesn't mean that you're not losing money. What it means is that the recovery time and the maximum drawdown are significantly less. And the last one was the great financial crisis, and that it took about 5+ years to recover. Maximum drawdown was actually steeper at about 53% down. It was global in nature, and yet even with this, you're able to recover in 38 months. And so about 3 years, and the maximum drawdown was certainly a lot less than the market. So ultimately, I think that the point here is that these things happen. We have to acknowledge that every once in a while we're going to have these grizzly bear markets. No idea when the next one is coming. I just think it's good to be prepared to know, what should I expect? I should expect that the market on the news, which is the scary thing, is going to be quite different than my own experience. And if I do stay disciplined, I keep reinvesting, and I balance the portfolio with international, small, and bonds, among others, then both the time to recovery and the maximum drawdown is likely to be a lot better than what people see on the news. And it doesn't mean that it's all milk and honey. It doesn't mean that you're not going to lose money. It's just going to be a very different experience. And when people say, "I don't have 10 years," well, if you plan accordingly, 3 to 4 years is something that most portfolios can manage before you get back to being in black.
It's interesting, I think diversification as kind of the only free lunch in investing applies here, obviously in the 60/40 portfolio context. When you look at kind of how the Magnificent Seven in terms of concentration risk impact the S&P versus the NASDAQ versus, a globally weighted portfolio, if you look at companies that are going out of business, somewhat everything that you've talked about here today, a big safety net so to speak, is a globally diversified portfolio.
and working with an advisor to have that coaching, the discipline, because I got to tell you, Jason, when I start talking to end investors in '07, '08, when we had that pandemic, not a pandemic, but the financial crisis, I thought I understood until you actually get punched in the face. I mean, that's what Mike Tyson
Yeah.
said. Everything's great. I got a plan until you get punched in the face. And all of a sudden, when you have something that everybody's screaming, it's unprecedented. The world is falling apart. Is the end of it. It's emotionally you have to be extraordinarily strong to stay disciplined, and that's why I think an advisor is absolutely crucial. I mean, I learned a lot going through that time, and I can tell you that without an advisor, it is exceedingly hard to stay disciplined. And I've met a lot of people who sold at the wrong time because they can't take it anymore, and they completely missed their recovery. They were never able to come back from that hole. So it's so important to work with an advisor and stay disciplined because it's times of crisis where advisors are like a firefighter. They jump in and they save people's financial lives. So it's hugely important to have an advisor and Appella in particular because it's so disciplined and strategic in the way they allocate money.
Yeah, we'll have to put a pin in that for when you come back in July. Maybe we can revisit the impact of missing some of those best days, the
Yep.
recovery and the extension that it puts
Yep.
on your time to recover. I know we've only got a few minutes here, but there is just an incredible question, very timely in the
Yep.
chat here from CJ, and it has some political underpinnings here. So
Yep.
I'll dance around this cautiously, as I'm sure you will with the answer. But CJ asks, what are your thoughts on the issues happening with the Fed chair and the fighting between him and the president? Is this setting us up as a country for significant financial risk?
Yeah, and so the quick answer is like, listen, we need to. It's kind of good to have a 2 minute perspective on this whole issue. If you go back to the Fed and when it was established, it kind of goes back more than 100 years ago when we had financial crisis in the early 1900s, and the way we solved them as a country literally was J.P. Morgan putting people into an office, locking them, and just saying, "You don't get out till you fix this." And then people realize, wait, we can't. This guy's not going to live forever. So who else is going to do it afterwards? And that's when the Fed came along. And the mandate of the Fed for a very long time was to regulate banks. And the reason for that is because from the 1900s, early 1900s, for many decades, we had the gold standard. So the way to print an additional dollar bill, well, you need to have gold in the bank. So that's how we function as a society for many years, up until the late 60s, when economists pointed out that we're just not digging up enough gold to print all the dollar bills that we need to function as a society. So back in August of 1971, President Nixon goes on TV and he tells the world that as of today, the dollar is no longer connected to gold. And we became something called fiat currency. And what fiat currency means is that the value of the dollar is not derived from a link to a precious metal, but because we all believe the dollar has value. And what's important about that moment in time is that the entity responsible for printing and releasing dollars in society was not the US government, not the Treasury, not the Congress, no, none of that. The only entity was the Fed. The Federal Reserve is the only entity that can release dollars in society through the way they buy things and sell things. So they're the only ones that release money in society, and they were entrusted to basically make sure that we have stable prices and we don't go nuts. And after this happened in the early 70s, for the entire decade of the 70s, what happened was the White House and the politicians were very intertwined with the Fed. So there was no Fed independence. They took orders from the White House, and the policy was all over the place, and it was terrible. We had high inflation, low economic output. A lot of bad things came from the fact that the Fed was not independent and rather was controlled to a good degree by the politicians until the late 70s when somebody by the name of Paul Volcker came along and he said, no more monkeying around. As of today, the Fed will be fiercely independent. We will not take any orders. We'll do the right thing, the decisions that we think are appropriate based on the data that we have, even though in hindsight, not always might be perfect, but we will base the decisions not on political reasons, but rather on what we think is right for the economy. And that has been the way that the Fed has operated since the early 80s. And if you look at this time frame, Jason, it's been an amazing success because the US dollar has maintained its stature in the world. It's still it's the inflation has been on average 2-3% per year, remarkable success in this experiment. And you know, the question is now that you have this situation of potentially politics enter back into play. I think that that is by most accounts, well, to most people tell you this is not a good idea. That the Fed should be allowed to continue to make decisions that are based on data and what they think is right for the economy, even though it might not be all agreed by everybody, rather than what benefits somebody politically. And the big risk here is that if you take away the independence, it might completely backfire to the goals that politicians have. Because if the goal of the politician is, well, we want to have lower prices or lower interest rates, here's what's going to happen. If somehow bond traders are getting a hold of the fact that the Fed is no longer independent, well, that poses a risk that perhaps inflation is going to go higher. And if inflation goes higher, what we typically see is that the interest rates on these longer term bonds, they also go higher because that's something that's determined by the market, not by the president or the White House or Congress. So a lot of times this idea is not a good idea because it could undermine your own goals. So if you look historically, I would have to say the Fed independence has been a resounding success. I think it's been a backbone of the economic success of the country. A lot of people argue that. And I don't know many people would say it's a good idea to give the politicians back a say and influence the Fed, but rather most economists, you saw most folks, whether they're politicians, officials, or even bankers saying, no, no, the Fed ought to be completely independent. And this remains to be seen. At least at this point, the market hasn't really priced in a really good consideration that the Fed might lose its independence. And what remains to be seen. But at the moment, at least the markets are saying, yeah, maybe there's some bark in there, but it's not really, there's not going to be much of a bite there. At least that's kind of what the prices are saying at the moment. But it remains to be seen. It's just, I do think that this is, you know, a lot of folks would say this is very fundamental to the success of our economic growth to continue to have the Fed independence.
Yeah, I totally agree and appreciate your thoughts and insight. And thank you, CJ, for the question and everybody else who asked questions throughout today as well. I know we've just hit that hour mark. So in respect of everybody's time, we do appreciate you joining us. Apollo knocked it out of the park again. I think we all feel a little bit better knowing exactly what happened in 2025. It was a year of many headlines and changing economic conditions and stock market highs and lows and volatility. But certainly appreciate your perspective, bringing it all into view. And we look forward to another successful 2026 and look forward to welcoming you back in July for our mid-year market update. And certainly to all folks who attended today, if you have any questions, follow-ups, comments, etc., feel free to reach out to your advisor and ask those questions. We'll look at anything that was still remaining in the chat and try to answer those after the webinar. Certainly appreciate everybody sticking with us here this evening. Appreciate all the questions and your time. And Apollo, as always, thank you so much for being a friend and a partner to all of us here at Apella.
Great fun seeing you. Thank you, and look forward to our next session.
All right.
Bye-bye.
Good night, everyone. Thank you.
Bye-bye.